Being able to live off dividends is a dream many people have, but they are often held back from enjoying their hard-earned wealth by 3 common myths and misconceptions about dividend investing. In this video, I'm going to explain why you should ignore these myths that may be holding you back from investing for dividends and living off passive income as fast as possible. The first misconception you may have heard is that you are better off investing exclusively for maximum total returns than focusing on investing for dividends. By allocating your money to investments that will produce the highest returns, you're numerically better off because you will end up accumulating the highest net worth possible. This is why many investors focus on growth stocks and ETFs like QQQ and other index funds that hold high growth companies but pay little in dividends. For instance, QQQ, which contains the top 100 companies in the tech-heavy NASDAQ index, only pays a dividend of 0.53%, but it's beaten the S&P 500 by more than 4-fold over the last 3 decades. But here's the problem. The average US life expectancy is just under 80 years. The first 20 to 25 years of which are spent in school, and the last 5 to 10 years of which there is a good chance you could have limited mobility, you could be living in a nursing home, or be suffering from some kind of physical or mental illness that greatly reduces your ability to enjoy the freedom your wealth could provide. Or in the worst case scenario, you could be dead before you reach anywhere near 80. Based on data from the Social Security Administration, you have a 30% chance of dying within 10 years by the time you reach 70. So excluding the beginning and last decades of your life, it doesn't leave a lot of time to enjoy the wealth you accumulated if you can enjoy it at all. My point is, working, saving, investing, and waiting for 3 decades to start enjoying financial freedom has a very high intangible cost that cannot be measured in dollars. So from a life satisfaction and quality measure, I would argue that you're not really better off investing solely to maximize your total returns. Instead, allocating a portion of your investable money to income-producing assets like high dividend stocks and ETFs or cash-flowing real estate may make you happier, more financially secure, and more fulfilled over the long run. Now, I am not arguing that investing to maximize your total returns is bad in any way. You obviously should do so to have a financially secure retirement at old age. But as you can see here, the most expensive time period in many people's lives are in their 30s, 40s, and 50s, when the pressure on their earned income to cover all their expenses like housing costs, car payments, and childcare is the highest. So it might be of greater value to supplement your income from your job with dividend income during those years so that it relieves the stress and risk of depending on a single income source. For example, imagine how $8,000 in an additional income during those peak years and beyond could transform you or your family's financial situation. If you consider median household income is about $69,000, that's like a 12% pay raise. Based on consumer spending data, that could pay for an average household's food expenses for an entire year with money to spare. And the best part is, earning $8,000 in dividends doesn't require as much capital as you might think. Let's consider JEPI as an example. This is a JP Morgan Equity Premium Income ETF, and it's one of my favorite high-yield dividend ETFs because it provides, in my opinion, the best balance of capital appreciation, low volatility, relatively low expenses for an actively managed fund, and a phenomenal 8% yield. At a yield that high, you would only need $100,000 invested to generate $8,000 in dividends every year. But it gets even better. You don't need to save up $100,000 dollar for dollar if you're trying to build up to that over time. Your money will grow on its own through compound interest, so the real question is, how much do you need to contribute? Based on the rule of 1.5, also known as Felix's corollary, you can get to that sum by contributing $66,000 over 7 years if you reinvest the dividends and assume a conservative 2% annual appreciation, or 9 years if you only reinvest the dividends with no appreciation to be exceedingly conservative. The 1.5 rule is a rule of thumb that draws on the same principles as the rule of 72. And it basically estimates that the future value of all periodic contributions equals 1.5 times the sum of those contributions. So in our example, if you contribute $66,000, then compound interest will do its thing to get you to $100,000. Now, there are some prereqs for using this rule correctly, so if you want to learn more about it, I will leave a link in the description that helps explain it in greater detail. Now, it's really important to keep in mind that JEPI and other ETFs that leverage options to pay massive dividends generally aren't taxed as qualified dividends most of the time. Some of it may be ordinary dividends, which are taxed at ordinary income tax rates, and some of it may be return of capital in which taxes are deferred until you sell. So if you're interested in investing in JEPI or any of your favorite dividend ETFs, right now Webull is offering 2 free stocks worth up to $1,850 for opening an account and depositing $100. Webull is an online trading platform that is commission-free, no minimum deposits, there's no cost to use the basic service. So you can try it out, get free money just by signing up and making a deposit. So claim your free stock now by using the link in the description, and by doing so, you also help support this channel, so thank you. The next myth you may often hear and must be debunked if you want to live off dividends as fast as possible is the idea that high yield stocks and even ETFs that hold them are risky and should be avoided. The logic is that high yields are a sign that a company is not doing well because the stock price can sink faster than any necessary changes to a company's dividend, which pushes the yield up. A recent textbook example of this is Kraft Heinz, ticker symbol KHC. This company's stock price was around $92 to $93 back in 2017 before it collapsed to around $20 per share in early 2020. Long story short, poor management and bad strategy drove it into the ground, and it's been in recovery mode ever since. Throughout all of this, its stock continued to pay out and even raised its dividend until it finally had to cut it in Q1 of 2019. And the movement of the yield shown here reflects this dynamic. At its peak, the yield was as high as 8% when Kraft Heinz future looked the worst. The good news is that an 8% or comparable high yield isn't always because a company is in bad shape. It's not that black and white. There are many high quality companies that offer massive dividends consistently and safely. Take for example, Enterprise Product Partners. It currently pays a 7.5% dividend, and it's consistently raised it for 22 years. It has never cut its payout, and all the while, its yield has ranged between 6 to 7% prior to the pandemic. Enterprise Product Partners is a midstream energy company that transports, stores, and processes oil and natural gas liquids, petrochemicals, and refined products. Its revenue comes from long-term contracts that generate stable cash flow regardless of commodity prices. Because of this, its dividend was never in serious danger of being cut due to the collapse of oil prices during the COVID shutdown. In hindsight, it would have been the perfect opportunity to lock in a phenomenal double-digit yield when its stock was a bargain with the rest of the energy sector. The bottom line is, you need to dig deep into why a certain company's dividend yield is so high. The company might be doing just fine, and it may be normal for that sector or industry to pay out excessive dividends, like in the case of midstream energy companies. These companies and others like REITs and BDCs or business development companies also benefit from more favorable tax treatment that allows them to pay out much higher dividends than a normal publicly traded company often structured as a C Corp. And just like stocks, you shouldn't dismiss high dividend ETFs just because the yields are so massive. Some of the highest paying dividend ETFs, like JEPI, involve selling options contracts to generate their huge dividends and do so on a monthly payout schedule. These dividends don't come from the companies they hold, but primarily from the premium received from selling covered call contracts, which is a trading activity that is not directly related to the dividend payouts of the underlying companies themselves. So yeah, if you want to live off dividends as fast as possible, you need high yielding stocks and ETFs. There's just no way around it. But don't presume high yield automatically entails higher risk. The next misconception that discourages many people from living off dividends as fast as possible is that they assume they need to replace their entire earned income with dividends, and more challenging yet, that they need to save up a multiple of their income to do so. Many financial sites, like Fidelity here as an example, tell you as a rule of thumb to save 10 times your income by age 67. If you look below, they say to save 1 times your salary by 30, 3 times by 40, and so on and so forth. Regardless of whether you want to live off dividends earlier or save for retirement, this is nothing more than a rule of thumb, and you're better off ignoring this one. It's a shortcut that doesn't reflect the reality of your financial situation. Your income does not determine how much you need to live off dividends. Your expenses determine that. If you make $100,000 and you only need $50,000 to live off of, it's a no-brainer you only need $50,000 in dividends annually. So obviously, if you're able to save a portion of your income to invest in the first place, your expenses are already lower than your income. But more importantly, if you want to live off dividends as fast as possible, lowering your expenses accelerates your ability to live off dividends faster. Plus, it saves you more money that you can invest, so it has an outsized impact on your ability to achieve financial freedom. But there's one huge expense that should really motivate you to transition to dividend income. These are the tax rates for earned income on the left, and these are the tax rates for dividend income on the right, assuming they qualify as long-term capital gains. It should be obvious that you pay a ton of taxes with earned income, and on top of these, you also have to pay Social Security and Medicare taxes. Most people don't think about these being an expense, just like a mortgage or a car payment, but it is a huge expense simply because you have earned income. But with dividend income, you pay zero taxes if your taxable income is at these levels, and it's lower at every income level above that compared to earned income tax rates. Also, no Social Security or Medicare taxes on dividend income. So it's all the more beneficial to lower your expenses and live off dividends as fast as possible. If you're interested in learning more about some of these tax strategies to do just that, I talk about it in depth in this video on the best accounts to retire early. Now, if you have no idea how much you spend and you are serious about living off dividends, I highly recommend you start tracking your expenses. You can't lower something if you aren't measuring it in the first place. So I suggest finding an expense tracker or a budgeting software, or just logging your expenses on an Excel sheet. If you found this video valuable, be sure to hit that like button, subscribe to the channel, and hit that notification bell so you don't miss out on future videos. Thanks for watching, and I'll see you guys at the next video.